Most people think debt becomes dangerous when the borrower cannot pay it. That is not usually how it happens. The real danger often begins much earlier, when the borrower can still pay, but only by changing what the money itself is worth. That is where the public gets fooled. They keep looking for a dramatic ending, a default, a missed payment, a loud emergency. What usually arrives first is something quieter. The debt stays alive. The system keeps functioning. The bonds keep trading. The checks still go out. And slowly, steadily, the currency does less work for the people who saved in it. That is the kind of problem I want to talk about. Because when a government reaches the stage where interest costs become enormous, the issue is no longer whether the debt exists. The issue is how the debt will be carried. Who will absorb the strain? Who will quietly pay for relief? And which investors are still positioned for a world that no longer exists. I have spent most of my life around capital allocation, balance sheets, incentives, and human behavior. And if you do that long enough, you learn something simple. When obligations become too large, policymakers rarely choose the clean solution. They choose the politically survivable one. That does not mean the choice is wise. It means it is easier to sell. And in debt-heavy systems, the easiest solution is very often the one least visible to the average saver. People hear that the United States is paying immense sums just to service the debt, and they still think the country has a debt problem in the future tense. No, that is already the problem. Once the interest bill itself becomes enormous, you are no longer talking about a normal budget challenge. You are talking about a structure that must constantly be fed just to remain standing. A lot of investors still misunderstand what that means. They imagine that trouble comes only if the government literally fails to pay. But sovereign systems have another path. They can keep paying while quietly reducing the real burden through inflation, lower real rates, and financial repression. The saver sees dollars arrive. The retiree still gets paid. The bondholder still receives coupons. Nothing looks broken in the theatrical sense. But the purchasing power underneath those payments gets thinner. That is the trap. To understand where this goes, you have to stop thinking like a voter for a moment and start thinking like a debt manager. If a country has obligations that are too large relative to what its economy comfortably produces, there are only a few broad exits. The first is austerity, cut spending, raise enough revenue, run real surpluses, pay the debt down honestly. In theory, people respect that answer. In practice, almost nobody votes for the pain required to do it seriously. Every line item has a constituency. Every benefit has defenders. Every tax increase meets resistance. A nation can talk tough about discipline for a very long time without ever truly choosing it. So while austerity is always presented as an option, it is usually an option in the way a locked emergency door is technically an exit. The second path is default. Just refuse to pay, erase the burden directly. That is the cleanest arithmetic and the messiest social outcome. A sovereign default at the center of the global financial system is not just a budget event, it is a credibility event. It would shake collateral markets, funding markets, reserve practices, banks, pensions, institutions, and public confidence all at once. That is why people invoke it casually and policymakers avoid it desperately. The third path is to grow your way out. Hope that productivity, innovation, demographic strength, and real expansion cause the economy to outrun the debt burden. Now I like productivity. I like innovation. I have spent a lifetime backing productive assets, but hope is not a funding plan. You cannot build a debt strategy on a miracle and call it prudence. That leaves the fourth path. You do not refuse the debt. You do not pay it down honestly. You do not outgrow it fast enough. You let inflation, controlled repression, and policy coordination shrink the burden in real terms over time. That is the path governments are drawn to because it feels less dramatic than default and less politically painful than austerity. The burden shrinks, the language stays respectable, And the people footing the bill often do not receive one large invoice. They receive 1,000 small ones, higher prices, weaker cash balances, long bonds that disappoint, savings that stand still while life gets more expensive. That is why I tell people the most dangerous tax in a debt-heavy world is often the tax no legislature has to vote on. It arrives through purchasing power. Think about a homeowner who borrows heavily and then lives through a period where wages, prices, and asset values all rise in dollar terms. The mortgage does not disappear. The homeowner still owes the same nominal amount, but the burden feels smaller because the measuring stick changed. The debt did not become virtuous. The currency simply became weaker relative to real things. Governments understand that arithmetic very well, and once you see it, you stop expecting honesty from a system built on political survival. Now history becomes useful, not because today is a carbon copy of yesterday, because incentives repeat. After World War II, the United States faced a debt burden relative to economic output that was extremely high. The country had financed a vast national effort. The debt sat there. The political system had no appetite for a brutal cleansing, and the authorities found a solution that worked for the sovereign, even while quietly punishing certain savers. Short rates were held low, long rates were restrained. The government financed cheaply, inflation ran, growth helped, and over time the debt burden fell relative to the economy. That period is remembered by many people as orderly. It was orderly if you look at it from the government side of the table. It was less pleasant if you were the person trusting long fixed claims while inflation was doing the real work. That episode matters because people remember only the broad success and forget the mechanism. The mechanism was not magic, it was control over the curve, control over real rates, control over who absorbs. Eventually, the central bank reasserted more independence because the arrangement had become too compromising. That historical break matters. It was not the monetary authority volunteering to become a servant of debt management forever. It was, in many respects, an escape from that role, which is exactly why I pay attention when modern policymakers and modern commentators start speaking in ways that imply a fresh era of coordination. The language may sound technical. The reality is simple. When debt gets too big, governments want lower funding costs. When inflation risk is still alive, cutting short-term rates can stir the wrong fire. Term investors fear inflation or excess issuance. They demand more yield to lend long. That is where the system gets trapped. The government wants relief. The central bank wants easier financial conditions. But if long yields rise while short rates fall, you have not solved the problem. You have simply changed where it hurts. This is where clever policy engineers try to invent a middle road. They say, what if we can push short rates lower without allowing long funding costs to spiral? What if we can create more demand for government debt without openly returning to the most obvious form of money printing? What if we can suppress yields through structure instead of spectacle? Now you are asking the right question because that is where financial repression gets modernized. A lot of ordinary investors think repression has to look like a giant headline. It often does not. It can look like technical adjustments, portfolio reallocations, regulatory changes, balance sheet reshuffling, institutional nudges. On paper, everything remains respectable. Underneath, the system is being trained to absorb more sovereign debt at terms favorable to the sovereign. That is the point. One possible method is inside the central bank's own portfolio. If the monetary authority shifts what it owns away from longer duration paper and toward shorter government bills, it changes the shape of demand without necessarily advertising the move as an emergency rescue. The balance sheet does not have to explode on cue for the financing effect to matter. The government gets support where it needs it. The optics remain cleaner than outright crisis key. The public sees machinery. The debt manager sees relief. But the second method is the one I think more people should understand, because it changes who becomes the absorber. If banking rules are loosened so that banks can hold more government debt relative to capital without the same constraints, then the banking system becomes a larger buyer. That sounds technical. It is not technical in its consequences. If banks are encouraged, allowed, or effectively incentivized to absorb far more sovereign paper, then long yields can be restrained without the central bank appearing as the obvious whale in the market. The buyer still exists. The support still exists. The rate pressure still gets softened, only now it is flowing through the banking system. And the banking system, of course, sits on the public's deposits. So the public may not see a giant money printing headline and still end up living in a structure where its savings base is indirectly serving the debt management project. That is why I keep telling people not to confuse cleaner optics with cleaner economics. A policy can avoid ugly branding and still produce ugly results for savers. If short rates are pushed down to relieve pressure, if inflation builds, and if long-term yields are prevented from rising freely by institutional demand management, then the sovereign gets what it wants. It borrows below the true inflation burden. The debt ratio improves in real terms. The state calls that stability. The saver experiences it as erosion. That erosion is not evenly distributed. The person sitting in cash for years gets hurt. The retiree living on fixed nominal income gets hurt. The owner of long duration bonds bought under the old regime gets hurt. The worker whose wages lag prices gets hurt. Meanwhile, the holders of scarce real assets, productive businesses, and pricing power are playing a different game. That is the division I want investors to understand. In inflationary repression, the world separates between holders of promises and holders of reality. Promises are stated in money. Reality has to be bought with money. When money itself is weakened strategically, reality wins. That is why I do not think the right response is panic. I think the right response is structure. And structure begins with admitting that doing nothing is not neutral. A lot of people hear about a debt strategy like this and shrug. They say the government always finds a way. That is true in one narrow sense. The government may indeed find a way to carry the debt. The real question is whether your portfolio is the thing being used as carrying material. That is where the public conversation becomes dishonest. People say the plan worked. Worked for whom? For the sovereign, maybe for the political class, maybe for institutions close to the pipe, maybe. But the saver who spent 10 years watching purchasing power erode while being told nothing dramatic was happening may not define success the same way. That is why I want to say something plain. If the next chapter of debt management relies on lower short rates, hidden demand support for government issuance, and a tolerance for inflation above what ordinary savers expect, then the person who sits passively in long fixed claims is volunteering to be harvested slowly. Not ruined all at once, harvested slowly. And slow harvesting is dangerous because people can endure it long enough to never rebel against it. They just feel poorer, tighter, and more confused. So what would I do if I expected a period of financial repression rather than a clean resolution? I would begin by dividing assets by job, not by ticker symbol, not by whatever is fashionable this quarter. By job, one bucket must preserve flexibility. Another must preserve real purchasing power. Another should sit at least partly outside the promise structure. And the whole design should keep me from becoming a forced seller in the middle of policy improvisation. The flexibility bucket matters first. I do not mean hiding for 10 years in dead cash. I mean enough short duration liquidity that I am not dependent on selling long duration assets into a bad environment. Treasury bills, high-quality short-term instruments, true reserves. Why short-term? Because repression hurts savers most when they extend duration blindly. A short bill matures. A long bond can trap you in a weak real return, while inflation does the real damage. So I would want liquidity but I would want it disciplined and short. The next bucket is productive businesses with pricing power. This matters more than many investors realize. If the measuring stick is being weakened, you want ownership in enterprises that can adjust with the measuring stick. Businesses selling necessary goods, essential services, infrastructure, energy, select healthcare, certain consumer staples, and other hard-to displace functions have a chance to defend margins while nominal conditions shift. Not every company can do that. A weak business with no pricing power gets squeezed from both sides. Its costs rise, its customers resist, its debt hurts, its story falls apart. A strong business behaves differently. It does not ignore inflation. It adapts through it. That difference compounds over years. The third bucket I would want is monetary insurance. I know many traditional investors become uncomfortable when gold enters the conversation. That discomfort does not interest me much. Gold is not there to charm you with a spreadsheet. It is there because it is not someone else's liability. In a world where the answer to excessive debt often involves making the unit of account less trustworthy over time, a measured allocation to physical precious metal has logic. Not worship. Logic. The goal is not to gamble your future on one metal. The goal is to refuse total dependence on a system whose preferred release valve is currency dilution. That is a different job, and it is a valid one. The fourth bucket is exposure to productive real assets. Land where it makes sense. Energy exposure where the economics make sense. Select real estate tied to real demand instead of fantasy pricing. Infrastructure connected to necessity, things people still need even when policymakers are improvising in the bond market. You cannot print productive acreage. You cannot digitally invent useful housing overnight. You cannot speak a pipeline, a transmission network, or a vital logistics asset into existence. That scarcity matters. When paper promises are being managed politically, claims on reality regain respect. Now let me be careful here. I am not telling anyone to sell everything tomorrow morning and hide under a table. That is theater. And theater is expensive. I am saying something far more practical. Look at your portfolio and ask which assets were built for a world of falling inflation, falling rates, and easy buy. The dip policy rescue. Then ask whether that world is actually the one ahead. If the answer is no, you have work to do. The mistake people make is waiting for certainty. They want the policy fully announced. They want the inflation already visible. They want the market already reacting. They want the newspapers to tell them the shift is real. By then the pricing is underway. Prepared investors do their emotional work first. They trim the weakest holdings first. They stop confusing habit with discipline. They stop calling inertia patience. They accept that an asset can be respectable in one regime and dangerous in another. That is maturity. There is also a social pressure problem here. If markets remain buoyant for a while, the careful investor feels foolish. Someone with leverage looks brilliant. Someone with all the wrong exposures gets lucky a little longer. Television makes it sound as if any caution is cowardice. That is the noise you must survive. Being early is emotionally difficult. Being late is financially difficult. I know which difficulty I prefer. And I would rather give up a piece of late cycle upside than become trapped in a structure whose hidden purpose is to transfer the burden from the sovereign to the saver. That is what repression is. A transfer, not a solution in the moral sense, a transfer. It says the debt is too large to handle cleanly, so the burden will be spread through weaker money, managed yields, and years of subtle pressure on holders of fixed claims. If you understand that, then you stop asking the wrong question. The wrong question is, will the authorities make the debt disappear? They will not. The better question is, who is being positioned to absorb the real cost of keeping it manageable? That answer determines how you should invest. I would want less duration risk than the average conventional portfolio carries. I would want more short-term optionality. I would want greater exposure to pricing power. I would want some monetary insurance. I would want more reality and fewer abstract promises. And most of all, I would want enough liquidity and enough emotional control to buy good assets later if policy errors create bargains. Because the irony of debt-heavy periods is that they punish passive savers and reward prepared buyers. That is how major fortunes are often built. Not by being reckless when everything feels wonderful, by being liquid, selective, and calm when the strain finally becomes visible. I have seen enough cycles to trust that pattern. The public rarely gets a clean confession from policymakers. What it gets are incentives, structures, and outcomes. So ignore the flattering language, watch the mechanics, watch where rates are being pushed, watch who is being asked to absorb supply. Watch whether the official answer is genuine discipline or simply softer repression with better marketing. That will tell you more than any slogan. If the coming years are shaped by a debt burden that is too large to cure honestly, then the country's plan may work well enough on paper. But paper success for a sovereign can mean real pain for a household that never adjusted. That is why I would not sit still. I would not wait for a perfect press release. I would not assume that because the system remains standing, savers must be safe. Standing systems can still quietly consume purchasing power. And in many eras, that is exactly what they do. So do the hard work while it still feels optional. Review the fixed claims in your portfolio. Shorten what should be shortened. Trim what only belongs to the old world. Add assets that can breathe inside inflation. Add assets that do not rely entirely on institutional promises. Build enough reserves that you are not forced into bad decisions later. Because when the debt burden becomes too big, the government does not need your permission to change the value of the dollar. It only needs your inattention. And inattentive savers are usually the first people chosen to finance a rescue they never voted for.